I'm John Hanna for CityTV.net in New York, and we have Dirk Van Dijk, Chief Equity Strategist at Zacks.com, joining us from Dayton, Ohio. Hey, Dirk, good afternoon.
Hey, John, how's it going?
Good, good, good. And yourself?
Oh, not too bad. Finally some good weather on this longest day of the year.
Oh, yeah, summer. Yeah, today it's the official start of the summer, right? That's about 1 o'clock
hmm
something this afternoon.
Yeah, something like that.
Yeah, it's currently
Yeah.
12:40 p.m. right now in New York City. Um, so what do you have for us today, aside from the great weather that you're having there?
Well, we got the existing home sales report this morning. It was a disappointing. Well, I can't say really disappointing report because it came in basically in line with expectation, but it was a downbeat report. Existing home sales only ran at an annualized rate of 4.81 million, roughly in line with consensus, but that's down 3.8% from April and 15.3% from a year ago. Now, the year-over-year figure to take with a little bit of a grain of salt because that was when the homebuyer tax credit was about to expire, so there's a sort of rush to get in and buy houses and get the tax credit. I mean, one would have had to been really, really stupid to buy a house in June or July and just miss the tax credit type thing. So yeah, the figure is a little bit inflated there, but that certainly doesn't hold true for the month-to-month comparison, down 3.8%. And the median price of an existing home also was down 4.6% from a year ago. Now, the median price of an existing home is not the best measure of home price sales. I mean, it can be very much affected by the mix of sales. But that sort of number is still very much in line with what the better but slower data, such as the Case-Shiller Index, have been saying, and actually points to a bit more of an acceleration to the downside. And when you look at the internals of where the housing was selling, it looks like it actually understates the decline. The reason for that is that housing sales were down, pretty sharply or we're down in three of the markets and unchanged in one in the census regions. The one that was unchanged was the West, which was and down 10% from a year ago, while in the Northeast, sales were down just 2.5%, and year over year we're down 13.5. The reason that's significant is that those two are by far the most expensive regions in the country. And so if you're having relatively more sales in the expensive regions versus, say the Midwest, which is the cheapest region, sales were down 6.4% on the month and down 22.7% year over year. And in the South, it was down 5.1% and 14.4% year over year. You should expect that there would be some upward pressure on the median home price. If you're selling relatively more houses in Westchester than you are in Dayton, Ohio, that should force the median up. So a 4.6% decline in the median home price is pretty discouraging, and unfortunately, it looks like that trend is likely to continue. The key thing to be concerned about with existing home sales is the price and then the inventories relative to the sales. because that gives you an indication of which direction home prices are going to be going in the future. Since it's an existing asset that's getting transferred, it really doesn't generate all that much economic activity, any given home sale. I mean, you can, people will tend to redecorate when they move into the new for them home. So that might stimulate some sales at a furniture store like Lazy Boy or something. And they might want to slap a new coat of paint on, so that might help a firm like Sherwin-Williams. But that sort of pales in comparison to what a new home sale generates. When you think of all the labor and wallboard and cement and lumber that go into actually constructing a home, that's a lot of economic activity. But home prices are just absolutely critical in that they are the primary, home equity is sort of the primary repository of wealth for the vast majority of American citizens. Stock market, is sort of important, but most of the stock market equities are really owned by the top 10% of the population in terms of wealth, while housing equity is sort of much more democratic and widespread. So and it's also a very highly leveraged asset. So a small decline in price can actually be a much larger decline in the actual value that the person has in their homes. And so this constant decline in home prices is really hurting people's wealth to a very significant degree, and it's going to continue. The sales were down 3.8% on the month. Inventories were down only 1%. So the months of supply rose to 9.3 months from 9.0 months in April. That's a really high level. Now it's below the record level that we had last June, but that was due to in June when it hit 12.5 months. That was due to this really sharp fall off in sales following the expiration of the tax credit. It's still much higher than a normal level of months to sale. Over the very long term, about 6 months is normal. During the run up to the housing bubble, it sort of routinely ran around 4 months. And when you get a high level of inventories relative to sales, that puts a lot of downward pressure on housing prices. Now, fortunately, housing prices aren't as out of line now as they were in, say, 2006 or 2007, relative to median incomes or relative to rents. So that should help put a bit of a floor on how much further housing prices are going to decline. But I would still emphasize that relative to rents and relative to incomes, housing prices aren't cheap. They're just sort of getting back to normal levels after they had been extraordinarily high relative to those metrics at the height of the bubble. So and there's nothing to say that we can't overshoot on the downside the way we overshot on the upside, but the odds are that it's going to be a relatively minor decline. I would say that probably we're looking at 3 to 5% more decline between now and say the end of the year. That would put us kind of in the middle of those historical ranges, and coupled with low interest rates, makes for pretty decent housing affordability. So there's still more decline, but we're not looking at a cliff. But even another 5% down, if you only have 5% equity in your house as it is, that means that you're going to be on the verge of being underwater at the end of the year, and being underwater is a necessary but not sufficient condition for foreclosures to happen. So we're not really out of the woods on the foreclosure story, and we could have more problems ahead with falling home prices, and it's also going to hurt people's confidence. Thinking that a few years ago they were worth a couple $100,000 because of their home equity, and now that's down to very little. And you kind of say, well, I'm going to be retiring in 15 years. I thought I was going to be able to sell this big old 4-bedroom house, with the kids having by then moved away, and we'll buy a much smaller place and use the proceeds to live off of. Those plans have totally gone out the window. So you say, well, what am I going to retire on? Well, I better start saving more from my salary and paying down debt. That means lower total demand. It slows the overall economy, and is one of the major headwinds that this economy has been facing. So, it was a pretty depressing report, particularly that rising inventory to sales ratio. It's been an upward trend over the last few months. It's not what we want to see, and definitely is indicating more future weakness in housing prices. So,
Okay.
but on the other hand, I've got to say that a lot of this was expected. It was telegraphed by the pending home sales numbers. And some of the indications that I've been reading are that June has picked up a bit in terms of the pace of existing home sales. So the pending home sales should be somewhat higher in June. So maybe this is temporary, but I was not very pleased with the numbers that came out.
That's Dirk Dijk, Chief Equity Strategist at Zacks.com, joining us from Dayton, Ohio, and I'm John Hanna for CDTV.net in New York.